Let's talk about share market in today's video. What is share market, how does it work, and what are its advantages and disadvantages, and how you can invest money in it. Stock market, share market, or equity market, all three mean the same. These are markets where you can buy or sell a company's shares. Buying shares of a company means buying some percentage of ownership of that company. That is, you become the holder of a percentage of that company. If that company makes a profit, some percentage of that profit would also be given to you, and if that company incurs a loss, a percentage of that loss would also be borne by you. Telling an example of this on the small scale, presume you have to establish a startup. You have 10,000 rupees, but that's not enough. So you go to your friend and tell him to invest another 10,000 rupees and offer him a 50-50 partnership. So whatever your company profits in the future, 50% of it would be yours, 50% of it would be your friend's. In this case, you've given 50% of the shares to your friend in this company. The same thing happens on a larger scale in the stock market. The only difference being, instead of going to your friend, you go to the entire world and invite them to buy shares in your company. Stock exchange is that place, that building where people buy and sell shares of the companies. The market can be divided into two types, the primary market and the secondary market. Primary markets is where the companies sell their shares. The companies decide what exactly would be the shares price. Although there are some regulations in this too, the companies cannot maneuver too much because a lot of it depends upon the demand. How much price are the people willing to pay for the company's shares? If its demand is high and a lot of people want to buy its shares, the company would obviously be able to sell its shares for a higher price. What the companies do nowadays is decide upon a range. There is a minimum and a maximum price. They decide to sell their shares within that range. A point to be noted here is that every share of the company has equal value. It is upon the company to decide how many of its shares it wants to make. If the total value of the company is 1 lakh, then it may make 1 lakh shares of 1 rupees each, or it may make 2 lakh shares of 50 paise each. 60% of the shares of Facebook are retained by Mark Zuckerberg. The people who have bought shares of the company can sell it to other people. This is called the secondary market, where people buy and sell shares amongst themselves and trade in shares. In the primary market, the companies set the prices of their shares. The companies cannot control the prices of their shares in the secondary market. The share prices fluctuates depending upon the demand and supply of the shares. So the prices of the shares fluctuate depending upon the demand and supply. Almost every big country has its own stock exchange. There are two popular stock exchanges in India. One is the Bombay Stock Exchange, which has around 5,400 registered companies. The other is National Stock Exchange that has 1,700 registered companies. With so many countries registered in the stock exchange, if you want to observe overall whether the prices of the shares of the companies are moving up or down, how do we view this? To measure this, some measurements have been put in place: Sensex and Nifty. Sensex shows the average trend of the top 30 companies of the Bombay Stock Exchange, overaging out whether the shares of the companies are moving up or down. The full form of Sensex, the sensitivity index, displays the same. The number itself means not a lot. The value of this number can be understood only upon comparison with the past numbers, because this number has been randomly decided. They decided at the start that the value of the shares of the 30 companies would be this. So we compile all the numbers and say that it is 500. So gradually the Sensex has been rising and it has reached the 40,000 mark in the past 50 years. So this shows how far up have the share price of these 30 companies gone in these past 50 years. There is another similar index, Nifty 50. Nifty shows the price fluctuations of the shares of top 50 companies listed on the National Stock Exchange. If a company wants to sell its shares on the stock exchange, then this is termed as public listing. If a company is selling its shares for the first time, then it is called IPO, or initial public offering. That is offering the shares to the public for the first time. To start investing with the internet, in place you merely need three things: a bank account, a trading account, and a DEMAT account. A bank account because you would need your money, a trading account to allow you to trade and invest money in a company, and a DEMAT account to store the stocks that you buy in digital form. Most of the banks today have started offering a 3-in-1 account, with all the three accounts encompassed within your bank account. People like us would be called retail investors, that is, common people who want to invest in the stock market. A retail investor always requires a broker. A broker is someone who brings together the buyer and the seller. For us, our brokers could be our banks, a third-party app, or even a platform. Thank you for watching.